Whisper level. I wasn't going to record tonight. It's late. The screens should be dark, and your brain deserves a break. But silver just pinned a number that changes how the next open behaves. 79.16. Not 79 something, not around 80. $79.16. And the carry is still positive, plus 0.75%. That combination is not calm. That combination is a loaded spring with a polite label on it. Because when carry is positive, the market is telling you, we can store it, finance it, roll it. And when the price is already $79.16, the market is also telling you, we're not waiting. Here's the part nobody wants to say out loud. The next open is not built for gentle steps. Most nights, price moves like an elevator that stops on every floor. Ding, one level. Ding, one more. Tonight, the cable feels tight. If the first real order hits a thin book, the elevator doesn't ding. It drops the rope and reappears 3 floors higher. So don't watch headlines first. Watch the number. Watch the clock. Watch the door where physical reality enters the paper world. If you only remember one thing from this intro, remember this. You're not preparing for a tick. You're preparing for a jump. Pause. Let me tell you why that matters, even if you don't trade a single contract. Silver is the metal that lives 2 lives at the same time. In one life, it's a price on your phone, an icon, a chart, a line that wiggles when the dollar wiggles. In the other life, it's a component with deadlines. It gets soldered, it gets plated, it gets consumed. It does not care about your macro thesis. Gold can sit in a vault and be patient. Silver gets used up. That single fact makes silver more violent when timing gets tight. At $79.16, you're not in the cute little breakout zone anymore. You're in the zone where every small friction turns into a shove. A refinery delay becomes a premium. A shipping delay becomes a shortage story. A shortage story becomes hoarding. Hoarding becomes, don't offer me paper. Show me metal. And the market can pretend for a while that those are separate worlds. It can let the paper price do one thing and let the physical flow do another. Until the moment the calendar forces them to meet in the same hallway. That's why this week is dangerous. Not because volatility is scary. Volatility is normal. What is not normal is when a market has to reprice while half the participants are mentally checked out and the other half are forced to act on schedule. You can feel it in the way $79.16 sits on the screen. It doesn't feel like a destination. It feels like a signpost that says, next decisions happen fast. So when I say the open won't tick, it will jump, I'm not trying to sound dramatic. I'm describing a mechanical problem. Too many time-sensitive decisions, too little depth, and a price level that turns hesitation into a gap. Now let's talk about the trap people fall into every year right here. The last week of December is when smart people make dumb assumptions. They assume liquidity will be there because liquidity is always there. They assume spreads will behave because spreads always behave. They assume the open is just the next candle. It isn't. Between now and the first sessions of January, the market is running through a narrow hallway. Month end, year end, tax positioning, risk books getting cleaned, inventory getting counted, statements getting printed, humans wanting to go home. And right in the middle of that hallway sits a simple fact. January 1st, 2026 is a market holiday in the US. The first real business day of the new year is Friday, January 2nd, 2026. That means the week ahead is not a normal week with a party in it. It's a chopped up week where timing compresses. Monday, December 29th, 2025 feels like plenty of time. Tuesday, December 30th, 2025 is when plenty of time quietly becomes 2 days left. Wednesday, December 31st, 2025 is when desks go skeleton thin and nobody wants fresh risk. That's the calendar trap. People think the danger is the news. The danger is the schedule. When participants don't want to provide liquidity, the book gets shallow. When the book gets shallow, price doesn't travel smoothly. It teleports to where the resting liquidity actually is. That teleport is your gap. So tonight matters because it's the seam. It's the seam between I'll deal with it tomorrow and tomorrow is already here. Watch how traders talk as the hours roll. The tone changes from opinions to obligations. I think becomes I have to, and whenever I have to shows up near a major number like $79.16, the market stops being a debate and starts being a stampede. Okay, you've heard the story. Now I'm going to show you the math that turns this from a vibe into a mechanism. Carry is supposed to be boring. Carry is rent. Carry is the small, sleepy cost of holding something over time. Financing, storage, insurance, the whole adulting part of commodities. Your title number says the carry is plus 0.75%. That's annualized. That's not a lot, and that's the point. Let's do the simplest version of the calculation. No fancy models. Just the logic. Take $79.16. Multiply by 0.75%. That's 79.16 times 0.0075. 79 times 7.5% is not dollars. It's cents on the dollar. Roughly 59 cents per year on a 1-ounce reference price, about 59 cents across an entire year. Now compress it to reality. 1 week is about 7/365ths of a year. So the carry for a week is about 0.597365ths. That's roughly a penny. About 1 cent. A month is about 33/65ths of a year. So the carry for a month is about 0.593365ths. That's roughly 5 cents. Sit with that. With carry at plus 0.75%, fair value drift is pennies and nickels. So if you see price behaving like it needs to move dollars, not cents, that move is not coming from carry. It's coming from urgency. It's coming from imbalance. It's coming from orders that cannot wait for perfect pricing. That's why $79.16 matters. Because it's a high number sitting on top of a tiny carry number. The market is basically saying, storage is not the problem. Money is not the problem. Which leaves the uncomfortable third thing. The thing nobody can print overnight. The thing you cannot conjure with a rate cut or a press release. Availability. And here's where the open becomes a jump. If the next meaningful decision is driven by availability, the order that hits the book is not price sensitive in the normal way. It's deadline sensitive. It's fill me sensitive. That kind of order doesn't nibble. It bites. It doesn't wait for the next tick. It reaches for the next pocket of liquidity. If that pocket is 50 cents higher, it pays it. If it's $2 higher, it pays it. So the math moment is not complicated. It's brutally simple. When the cost to carry is pennies, but the market is acting like it needs dollars, you're looking at a constraint that isn't financial. That's why tonight is a setup, not for a pretty chart. For a discontinuity. Watch the number, watch the clock, watch the door. If the door swings even a little, $79.16 won't behave like a price. It will behave like a launch point. Picture a procurement manager at a mid-sized solar component shop in Penang. Not a trader, not a chart addict. A person with a calendar, a factory floor, and a boss who says, the shipment leaves when the truck arrives. On Monday, December 29, 2025, the manager opens an email thread that has been running for months. The company signed a supply agreement earlier in Q4, deliver coated conductors for a January build. The penalty clause is plain. Miss the window, eat the chargebacks. Silver isn't a nice to have in this line of work. It's paste. It's plating. It's the thin layer that makes the product work. And the contract doesn't care that a price feed is spiking. The contract cares about delivery. They need about 1,200 kilograms of silver input for the first 2 weeks of January production. In metal terms, that's about 38,600 troy ounces. At $79.16, that's about $3.06 million worth of silver. Before you even talk about fabrication, freight, insurance, or credit terms. Now here's the part that sounds small until it eats your week. They don't buy all 38,600 ounces at once. They ladder it. They schedule it. They lean on relationships. They assume there will always be some supply at some premium. But this week is when the supplier stops talking like a partner and starts talking like a risk manager. The quote is good for 2 hours. We can allocate, but we need confirmation today. Delivery in January is possible, but the premium is different. Cash today gets priority. The manager checks the screen and sees carry still positive, plus 0.75%. That's supposed to whisper, relax. Holding metal isn't expensive. Yet every human on the phone is acting like time is expensive. Because time is expensive. If the paste line pauses for 3 days, the company doesn't just lose metal. It loses throughput. Workers still get paid. Customers still demand the ship date. The whole operation becomes a game of catching up in a week when half the world is out of office. So the manager does what real-world obligations always do to a market. They turn price into availability. They call the hedging desk and ask a question traders rarely hear from traders. Can you guarantee we can get the metal, not just the hedge? The desk can put on futures, sure. One COMEX silver futures contract is 5,000 troy ounces. For 38,600 ounces, that's roughly 8 contracts if you want to be covered. At $79.16, one contract represents about $395,800 of metal value. 8 contracts is a hedge that looks neat on paper. But the manager doesn't get paid for neat paper. They get paid when boxes leave the building, so they push for delivery terms. They push for confirmed allocation. They push for what happens if the supplier rationing gets worse after New Year's Day. And that is how a normal corporate week turns into the kind of order flow that makes an open jump. Not because someone is greedy, because someone is late. Now tilt your head and look at history, but don't look for the same price. Look for the same feeling. Late January 1980 is remembered as the famous silver blow-off, when prices went parabolic and then collapsed. Most people retell it like a morality tale about speculation. The mechanical lesson is simpler. When positioning, financing, and real-world constraints collide, the tape stops behaving politely. Fast forward to April 2011. Silver ran to around the $50 area. A level that shocked people who assumed metals move slowly. It wasn't a smooth escalator. It was a sequence of lunges, pullbacks, and repricings that happened faster than the crowd could emotionally process. And then the rules of the game tightened. In late April into early May 2011, margin requirements for silver futures were raised multiple times in a short stretch. That did two things at once. It forced some participants to reduce exposure. And it reminded everyone that liquidity is not a promise, it is a mood. Now jump to March 2020. In the early pandemic chaos, a lot of markets discovered the same ugly truth. When logistics seize up and risk limits snap tight, prices don't glide to fair value. They gap to wherever the next willing counterparty is hiding. Different years, different catalysts, same mirror. A market that looks liquid on a normal Tuesday can feel like a narrow bridge when the calendar squeezes when people must act, and when the question shifts from, what's the price? To, can I get it when I need it? And silver has always been unusually good at exposing that seam because it sits between finance and industry. It doesn't just store value, it gets consumed. Now bring your attention back to the physical pathway, because this is where the storyline stops being abstract. The paper world can trade 10 times before breakfast. The physical world moves at the speed of trucks, vault schedules, and inspection stamps. One standard silver futures contract represents 5,000 troy ounces. Physical silver for large settlement often shows up as big bars, roughly 1,000 ounces each, moved under warrant through approved channels. So when someone wants 5,000 ounces, you're not talking about a little bag. You're talking about 5 heavy bars, and every bar has to be in the right place, with the right paperwork in the right window. Now scale that to the procurement manager's 38,600 ounces, that's roughly 39 big bars. 40 bars doesn't sound like a lot until you remember what actually happens at year-end. Warehouses take inventory. Staffing thins. Carriers run holiday schedules. Banks have cutoffs. Compliance teams go into no surprises mode. If a transfer needs a signature, that signature is suddenly hard to find. And physical demand doesn't need to be huge to create stress. It just needs to be urgent. Because urgent changes behavior. If a user needs bars in the first week of January, they can't wait for the cheapest offer. They'd pay the premium that clears the bottleneck. If they can't get the bars, they start grabbing substitutes. If substitutes aren't available, they start bidding for anything that settles their obligation. That's when delivery pressure bleeds back into paper. A futures hedge is only comforting if the cash and carry chain is functioning. If someone can't locate metal, the hedge becomes a reminder that they still have to solve the real problem. So they pull harder, they pay up, they scramble to lock in. And when multiple participants do that at the same time, the market doesn't discover price, it relocates. This is why that $79.16 level is not just a print. It's a doorway. If the doorway gets crowded, the first trade of the session won't be a polite check-in. It'll be a shove that lands at the next clear space. And the next thing we have to talk about is the other crowd at the doorway. The crowd that isn't buying metal at all. They're buying convexity around one number, and they don't negotiate with your feelings. You know that feeling when you're standing in front of an elevator, finger hovering, and you can already hear the cable creak? That's options flow when price parks itself right under a round number. Silver at $79.16 is not just near 80. It is close enough that every trader with a strike ladder starts behaving like the number is a magnet, and every market maker starts behaving like the magnet has teeth. On COMEX, the underlying futures contract is 5,000 troy ounces. The minimum price fluctuation for an outright move is $0.005 per ounce. That's $25 per contract for one tick. So when you see a move of 50 cents, that's not a vibe. That's 50 cents times 5,000 equals $2,500 per contract. A $1 jump is $5,000. Now place that math next to the way strikes are listed. When silver is above $25, strikes are commonly spaced at 25 cents increments around at the money for the active listings. That means the world is chopped into neat rungs. 79.00, 79.25, 79.50, 79.75, 80.00. And the market is sitting at 79.16, leaning toward the next rung. Here's the mechanical part people miss because it looks invisible. If a big pocket of call options is sitting at 80, someone sold those calls. Maybe a fund sold them for yield. Maybe a producer sold them to lock revenue. Maybe a trader sold them because they were sure 80 would hold. Whoever sold them, someone is on the other side providing liquidity. A market maker, a desk, a machine. They don't want a story. They want to stay neutral. When price climbs toward the strike, the sold call behaves less like a sleepy lottery ticket and more like stock. The closer you get, the faster its sensitivity changes. To stay neutral, the seller hedges by buying futures as price rises and selling futures as price falls. Read that again slowly. Near the strike, up moves create forced buying. Down moves create forced selling. That's why the open doesn't tick. If the first push after the bell nudges price from 79.16 towards 79.50, the hedging flow can turn from light to urgent inside a few rungs. If price prints 79.75, the elevator doors are already sliding shut and everyone is deciding whether to jump in. And because this is a holiday squeezed week, the book is thinner than it looks. So the hedge doesn't get done with delicate limit orders. It gets done with whatever clears. That's how a market gaps without news. It gaps because the people who promise liquidity are suddenly the ones chasing it. If you want a picture to hold in your head, use this. The price is a crowd pressing into the elevator. The strike is the doorway. The hedger is the person holding the door button, trying not to crush anyone. At some point, the force is too much and the door either snaps open or slams shut. $79.16 is where the crowd starts leaning. Now let's talk about the part that turns leaning into falling. Margins. Margin is the building manager. It decides who is allowed to ride the elevator when things get wild. You don't need a new rulebook to know how this ends because we've watched it before in silver with a date stamp. In late April and early May of 2011, the exchange raised margin requirements on silver futures multiple times over about 2 weeks, by a total of roughly 84%. Around that same stretch, the required funds per contract rose from about $11,745 to about $21,600 after May 9th. Open interest fell by around 15% as the increases hit. That sequence matters more than the headlines that year. Because when margin jumps, two things happen immediately. First, anyone running hot leverage has to come up with cash or cut the position. Second, everyone else learns the same lesson at the same time. Liquidity is conditional. Combine that with a holiday calendar, and you get a special kind of quiet panic. On Wednesday, December 31st, 2025, the U.S. bond market has an early close at 2 p.m. Eastern, while stocks trade a full day. On Thursday, January 1st, 2026, major U.S. markets are closed for New Year's Day. Translate that into behavior. Some desks are already reducing risk ahead of the early close. Some risk managers are already tightening the leash because they don't want a surprise when half the team is offline. Some liquidity providers step back simply because staffing is thin and nobody wants to be the hero in a quiet week. So when the open comes, it may not feel like a normal open. It may feel like the first crowded minute after the building reopens, when everyone tries to ride at once and the system strains. This is where you need a simple test you can run without guessing. Watch what happens the first time price tries to cross 80. If it trades 80.00 and instantly snaps back under 79.75, the market is telling you the door is still resisting. If it trades 80.00 and holds above it long enough that 79.75 stops printing, the market is telling you something else. The hedging flow has flipped from contain to chase. The second test is even plainer. Look at the size of the move versus the tick. If silver is moving in clean $0.005 steps, it's breathing. If it starts skipping rungs, printing half-dollar bursts where you expected pennies, it's not breathing, it's relocating. And the third test is the one nobody likes because it forces patience. Does the market give you a retest? A real, healthy break often comes back to touch the level it broke, offers it, bids it, and decides. A stressed break doesn't come back. It can't. The people who need fills won't let it. If the break doesn't retest, that's when gaps are born. So here's a roadmap for the next 3 to 10 days, spoken like a person who wants to stay alive, not like a person who wants to sound smart. Over the next 3 sessions, treat $79.16 like the center of gravity and $80 like the doorway. If price keeps returning to the high 79s and bouncing, the market is storing energy. If price rejects the area and spends time below the mid to low 79s, that tells you the crowd stepped away from the elevator and the building is calming down. Between Friday, January 2nd, 2026 and the middle of the following week, watch whether liquidity returns. Not volume, not chatter, liquidity. Do you see tighter spreads and smoother trade through, or do you still see prints that jump? If the book stays jumpy even after the holiday, that's a warning that the constraint isn't just calendar-thin staffing, it's deeper. And if you get the upside scenario, don't get hypnotized by green candles. Ask a better question. Is the move being paid for by fresh money, or is it being paid for by forced hedging and forced covering? Because forced flows burn hot and then cool fast. Fresh demand tends to persist. You can't always know which is which in the moment, but you can watch the behavior. Forced flow looks like sharp bursts and shallow pullbacks. Real demand looks like dips that get bought with patience. And if margin changes appear, even a small adjustment, treat it like someone switched the building lights from bright to dim. People misstep in the dark. Now I'm going to nail the point down, because if you only remember the drama, you'll miss the tool. Tonight's number is $79.16. Carry is plus 0.75%. Carry says the cost of time is small. The calendar says time is scarce anyway. Physical obligations say delivery beats elegance. Options hedging says near 80. Moves can amplify themselves. Margin and holiday liquidity say there may not be enough hands on the railing. Put all of that together and you get the sentence you came for. The open won't tick, it will jump. This is not financial advice. It's not a prediction. It is a map of how a market can behave when mechanics stack up in the same week. If you trade, size so you can survive being wrong. If you don't trade, use this as a way to read stress before it shows up in the headlines. If you want, I can also convert this into a tight on-camera read with pauses and breath marks, or a shorter version for a 60 to 90 second clip. Tell me which format you're building.